Good afternoon. This is Adam Pincus, and this is a panel we're hosting today with Pincus Co. And I appreciate your joining, and I want to thank our guests for joining. I'd like to start with an introduction. This afternoon, we're discussing what is a sensitive topic, and at the moment, when the market remains relatively weak and battered by oversupply, also by, of course, the pandemic and all sorts of decisions being made in the city. So we're all approaching this conversation from a point of view of humility, first to acknowledge that the developers on these projects that we're going to be talking about had the internal fortitude to attempt to build a condo, and in fact are building condos in New York City in the first place. And second, because the information that Pincus Co. is going to be displaying is the information that we can generate, and it is not necessarily, it's hard to know if it's completely accurate. So we say that with humility as well. That said, our analysis indicates that these condos that we're going to be talking about are relatively slow in this market. We are looking only at closed and recorded sales, excluding contracts. In this discussion, I'm going to discuss projects and show the sales stats that we have for them. And then the panelists can comment on the market, or if they want to, on the particular condo. But most likely we'll just be talking about sort of about trends. And then basically the idea is how a developer could move their project forward or take some other avenue. We're going to discuss first condos in Manhattan, then Brooklyn, then Queens. So first I'd like to introduce the panelists. This is not in any kind of order. Marc Sznajderman, Senior Managing Director at Ackman-Ziff. It's an active boutique real estate capital advisory firm based in New York City. Over his career, Marc has been responsible for over $20 billion of capital markets transactions on behalf of public companies, private equity funds, REITs, and privately held owners and operators. Robin Sznajderman, Managing Director of Brown Harris Stevens Development Marketing, advises clients and capital partners in underwriting deals and projecting future sales. Additional services include broker opinion of value, detailed comp reports, and pipeline of future developments. Patrick Smith, Associate Broker at the Corcoran Group. He's a new development expert with the Corcoran Group. He focuses on the outer boroughs and publishes a widely followed proprietary report on the LIC community condominium market. Dovi Lesches, principal with Empire Equities, which is a New York-based real estate development investment firm that owns, operates, and manages a mixed-use portfolio of mostly residential, commercial, and hospitality real estate in New York City and Florida. And Jamie Anthony is the founder and principal at Lonicera Partners, a Brooklyn-based real estate investment development company. Lonicera's primary focus is residential ground-up development. Wanted to start with Jamie as the main ground-up developer here. Just what's your mood of the market today? And thanks for joining.
Yeah, Adam, thank you for the intro. It's good to see everyone on the panel. I think you hit the nail on the head with your introduction. This is a topic that's fraught with a lot of emotion, an abundance of nuance, and it needs to be considered and talked about in a thoughtful way. I think as a developer, and I'm sure everyone else on this panel has seen in the past, there's typically a very broad brush used when describing New York real estate, and that is never the case. And I think it's, as you mentioned, I think we're sort of in a historical first, right? Prior to COVID, we were experiencing a soft market in the condominium sector. And obviously that soft market has been incredibly exacerbated by COVID, which by its own nature affects dense city populations and markets more than anything else. So I think what we're experiencing in New York City is unique amongst United States. But I think we can all say that there's some cautious optimism right now. I mean, condo development, the condo market is the most sensational part of real estate in New York City. And as this last sort of election cycle has taught us, if we're still in it or not, I don't even know. Sensation sells. So the blood in the water news headlines that you read every single day, it catches eyes. Again, I think it's painting with a very broad brush, and it's ignoring a lot of the nuances that I think need to be considered. I think with Pfizer and Moderna's announcement of hopefully a solution to this pandemic, a very effective one, is sort of it's piqued our cautious optimism. We were optimistic prior to that, but I think generally speaking, New York in down markets, when you have recessionary periods, New York is the least elastic and it's the first to bounce back. And I don't think it's going to be any different with this. I think it's unique, but I don't think we're going to see anything different coming out of this recessionary period than we have in every other one.
So I would like to look right now just quickly at some of the kind of projects that we're going to be looking at today in Manhattan. We're using an example of 25 Park Row as a project that's selling pretty well right now. And then a couple other condos, 111 West 57th Street, 200 East 59th, 138 East 50th, which is 16% sold units. 1182 Broadway has just 11 sold units. And wanted to get ideas from the panelists of sort of how these different, not necessarily how the projects, but I guess I wanted to ask Robin, like 111 West 57th was a project that's sort of audacious to begin with, but it got its TCO. So like, what does that mean for that? Like, how do you frame that in terms of its future? Robin, you're muted.
Better?
Yes.
Okay. Thank you, Adam. What I was going to say is before we go, dive into some of these projects, if you don't mind, I could give some color to the condominium market. From COVID, which hit the market essentially in March 13th, and then the city was locked down, until June 22nd. And what I mean by that is that the residential brokerage community could not physically show any apartments during that time period. And then the city released the lockdown, and then we started to show more actively. So just to sort of give some top line stats, from March 13th to June 22nd, and this is a new development focus because I believe this panel is focused on new development. There were 94 units that were signed from March 13th to June 22nd. And then from June 22nd to November 19th, there were 332 units signed. So during the lockdown period, there were still actually, some contracts being signed on average 6.7 per week. And then from June 22nd to November 15th, we averaged 15.8 per week. So, this is not huge numbers when we look at it a year over year, but they are promising numbers that show us that the market is still alive and well, and absorption is certainly down. When you look at that on a dollar volume, we're down roughly 60% year over year in terms of for the lockdown period and the post lockdown period. And as of now, the fourth quarter currently has 154 signed contracts, and we projected based upon that number, there'll be roughly 70 more, which would get us to roughly 225. And when you look at the third quarter we are about 167. So that would be a 28% increase in the fourth quarter of signed contracts. So yes, I agree with Jamie. We are certainly cautiously optimistic, to say the least, but there is definitely a sense of the city reawakening, and I do feel that the buyers out there that perceive the Manhattan condo market as a long-term value are recognizing this opportunity. And when you look at the average price reduction for these apartments since lockdown, the average price reduction is roughly 15%. So there's certainly buyers out there that are noticing this, and I think they're getting their ducks in a row and making offers and doing what they can to negotiate deals.
And that, okay, but on the idea of someone getting their TCO right now, is that got an impact on? I mean, obviously they need the TCO to start sales, but are people still getting their TCOs?
The most interesting statistic that we've found since COVID, from a market sentiment standpoint, is roughly 90% of all contracts that have been signed since March 13th are in buildings that offer a TCO. So the idea of pre-sales, and our team, and all of our competitors build out these beautiful fancy sales galleries, and we give a buyer the vision of what a project will look like, and now buyers just don't, in this current climate, have any sense of urgency. But if you show them a completed product that has a TCO and has declared the condo plan effective, then the likelihood of people signing contracts and moving into apartments immediately, or after they can get their financing lined up, is much more likely.
Mm-hmm. And Marc, I wanted to ask about one of the options is for people to get a condo inventory loan, and how are you seeing that right now? How big is that in your business right now?
I mean, it's the kind of thing that is, I wouldn't say it's a huge part of our business at the moment, but it's definitely an area that we're focused on that I think is going to be growing. I think in this environment where you've had delays on construction in certain projects and sales that maybe were slower than what was originally projected, the original lenders generally are, have hurdles to grant extensions and are reticent to give extensions beyond what are provided for the loan documents, generally speaking. And I think the good news is that the capital markets have been quite, robust, particularly with respect to bridge lenders and non-bank lenders and others that would consider providing condo inventory financing. The challenge is, at what basis and are you able to take out your financing? So I think that if lenders who have 30% sold or 40% sold, they're paying down a significant amount of their construction financing, generally speaking. And I think the market is relatively conservative with respect to looking at what loan per square foot levels they're comfortable with. And when they look at the remaining inventory in some of these buildings, they want to see that there's diversity within the inventory, that there's sales that have taken place, that there is a sponsor that's strong enough to carry the project for an extended period of time, because the carrying costs with respect to common area charges and taxes can be substantial. And it's developers project sales when they do their original pro formas, and they're assuming that that's going to get paid down and that those common area charges are going to be offloaded to the buyers. But obviously, if that doesn't happen according to plan, that remains the responsibility of the developer, and it can be significant. So I think in general, there is financing available, and the markets are strong, but it's conservative overall with respect to leverage and with respect to business plans and sponsorship.
Are there any new kind of tricks out there that people, either a sponsor is using to try to figure out how to rejigger his or her equity stack, or from a buyer perspective?
I think we're in a market environment where equity is seeking, to invest in condominium projects right now. Equity is generally seeking opportunistic types of returns, and so to come into a project where, I would think new equity would be looking for some sort of preferred return, kind of a white knight type of capital, and developers in general are going to be forced to be subordinated in the capital stack if they need to find new equity for a project. So I just think, condominium is generally a narrower market with respect to equity investors, joint venture, particularly institutional equity investors, which is where most of our work is done. And I think to attract new equity into condominium projects today, just realistically, they're going to be conservative as well, because they don't want to have, the egg on their face. So they're going to look for some subordination from the developer. But there is capital, and we do have a pretty good list of folks that are looking for the right opportunities.
And Dovi, are you looking around in Manhattan and to try to buy, or how are you looking at it?
Yeah, absolutely. Thank you, Adam. And actually, I have a question for Marc. We just heard, Robin allude to the fact that, some lenders and sponsors have been looking at a 50%, discount post-COVID. Are you seeing the capital providers, lenders, new equity out there look at the same sort of analysis in terms of rejiggered value, or are you seeing a deeper discount?
So I guess the question is, if what we have seen so far in the market is if there's bulk sale opportunities, that those investors are looking for pretty substantial discounts from the original sales prices that were marketed. And I think that a lot of that money that has been looking to acquire bulk condos have looked at it in a way so that they could try to get to some very minimal return on a current basis to lease up the units, cover the carrying costs, and then get to, even if it's a 2 or 3% return, they're happy with that. The problem, generally speaking, is a lot of the luxury product was at a basis that it's difficult to substantiate, or the units were larger units, so it's difficult to get the rents per square foot to generate those kind of returns. So as a result, they're looking for significant discounts in the bulk sale market that we have seen.
Right. So Adam, to answer your question, it's yes, but there's such a divide in terms of what, our capital typically looks for in terms of returns and, asset class and so on, and what we're the individual end user, which is in some cases how we would offload and free up some cash flow. So the divide is such that, we're trying to follow a certain return, and at the same time, I think some developers, be it with forbearance, be it with additional time from their lenders, are not necessarily feeling pressured at this point. So we're sort of stuck in this point of the market where it just feels like everything is neutral and stale, where developers have options. They're not hard pressed to get a deal done today, and therefore pricing, what we would consider, post-COVID or mid-COVID pricing, has yet to fully take effect, and therefore it's just been very difficult. I mean, we came off 2 acquisitions in the last 9 months, nothing to write home about, but we've been at it every single day, and we are constantly arriving at the same juncture, which is just the capital that is out there has been punting largely to Q1 of 2021 is what we found, and there's developers with options, so there's no real need to push for a sell at this point.
So one of the options that, just to pivot to some of the exit plans that a current developer has, I had been looking at a project, we did analysis and looked at 1182 Broadway, and it appears that they have gone rental. I wanted to ask Patrick about sort of that as one of the options, not on that particular, because you focus mostly in the outer boroughs, and this is in Manhattan, but just like the concept of somebody going rental. What does that mean for the sponsor?
Well, it depends on what the sponsor's cost basis is in the building. So I think in the case that you cited, the owner there might have been, might have owned that building for quite a long time. So in effect, they were able to renovate the vacant units, bring them up to a condo standard. And if they did not receive the kind of response they were expecting, they were able, in that case, to pivot to a rental. My colleague who was just speaking about some of the, ultra luxury properties that are very large and don't pencil out as rental units, they don't have that option.
And Jamie, just on the, we're talking about sort of where developers are right now with some of these. Are you being approached with to consult on maybe like busted or projects in a squeeze as a developer to come on and help them? Does that happen?
Yeah, it does. But I think Dovi hit on an important topic, which is we're in a very odd moment right now where everyone knows that there's an incredible amount of distress in the market, but we are fundamentally in a period of forbearance. So to his point, developers and owners have not been put in a place where they have to react or being pushed to foreclose. And that's pretty unique. I think Marc was touching on this as well. You know, the position that this market is in right now is not the result of a financial industry collapse. There is an enormous amount of equity and debt out there. There was prior to COVID, and there is more now because there wasn't a lot of investment over the past 6 months. So, you know, to Marc's point and to Dovi's point, there's a lot of equity sitting on the sidelines. But given this weird moment in the market where people believe that there's going to be a lot of really great value add investment opportunities, they're pretty much sitting on the sideline waiting for that to happen. I think that a lot of the distress is going to result in, call it trades or foreclosures or trading hands, wipe out of equity starting in the first quarter of 21. You know, we're probably on the second, third, maybe even fourth forbearance agreement for some projects. But it's been, you know, frankly, as a developer, and it's been sort of an uplifting, you know, process to see, you know, all the lenders, all the equity providers come together in this time and provide the runway to people, because this is exogenous as hell. Like, this has never happened before, and what's happening is unique. And I think people are given a lot more rope than they would in any other condition. But you know, so we've been approached. I've been approached, but that distress that's going to result in those sorts of transactions just has not come to the surface yet.
I wanted to just share a little bit with some of the way we were looking at these stats. So these are charts of closed and recorded in Acris for these different projects. So Park Row got several things closing in recent months. 10 Riverside Boulevard has a pretty good bunch of closings. Then Charlie West, the 505 West 43rd, hasn't had closings in a couple, or very few closings. 138, just a couple. 111, this only adds up to about $12 million, $10 million or something. So for 111 West, they've got a big ones in contract, but they haven't closed and recorded yet. And these are some others. That's 1182. Just the idea on 1182, or just not 1182, but just any project that thinks about going condo then goes rental. Can they sell, or I guess Robin, can they then sell those units? Like, if I say, hey, I'm now a rental, can I turn around and sell if someone comes in and is like, I totally want that unit?
Well, there was a key change in the condo conversion laws last year. And as of June 30th, you had to file a condo conversion if you were going to proceed with that. So the unique thing going forward is, if you declare your condo plan effective, and what that means is you have sold 15% of your units, you then can certainly rent out those units for however long you want, and the building is grandfathered as a condominium. But if you are in a building that has not declared your offering plan effective, and you start renting units, you can no longer convert that building from a rental to a condominium unless you get 51% of the people living in the building, the tenants, to buy a unit. So that is something that has, really changed how developers or even really, I guess, lenders, if somebody ultimately takes back a project from, an ownership perspective, and if they ultimately decide to rent those units, you can only then have it as a rental. So, you know, there's not that many examples of buildings that are less than 15% and the building is completed. One that a lot of people are talking about in the market right now is the Hayworth on 86th and Lexington Avenue. It's a very unique situation because the building is 100% completed and they have not declared the condo plan effective. And they have basically no units in contract. So they have a decision to make, and there could be a new investor that comes in potentially to, you know, buy into the capital stack or whatnot. And if they ultimately then take control of that asset, they have the option to keep it as a rental, or they can start selling the inventory off at a discount because unfortunately the equity's been wiped out of the deal. But I can't think of too many buildings in New York City, specifically in Manhattan, that are 100% completed and have not declared their condo plan effective.
Adam, what I was going to just mention is if you look at some of the projects that you listed, you know, if you look at the timeline from when somebody starts a land acquisition on a project in New York City and puts plans together, gets financing, gets it in the ground, completes the project, and then actually starts to deliver units, in some cases you're talking 5 years, 6 years. I mean, in 111 West 57th, which had some very public delays in construction. I mean, that project could have started 10 years ago. I don't really know. And I think they were conceived, some of them, at a different point in time in the market. You know, Robin and Patrick could certainly comment on this better than I could. But there was, you know, a point in time when there was a lot of foreign buyers that were more prominent in the market. And I think there were currency controls in China and in Russia and other places that limited for some of those types of properties with much larger units and higher. It's a, you know, like 111 is a phenomenal building. If anybody's been in there, it's a beautiful product. And, you know, but I think if somebody was starting a project today in this environment, thinking who the buyer pool was, and I'd love to hear from Robin and Patrick on that, you know, you would conceive probably a different type of project, you know, and be much more focused on cost basis and things like that as a matter of fact, which just, you know, on a 57th Street project, you can't do that because of costs in general, but I'm sure many other projects in other neighborhoods are in a much better position or will have an easier time as we come out of this between stimulus, low interest rates, and pent-up demand, and we'll be fine. But it's good. There will be haves and have-nots, unfortunately, in the market.
Yeah, I think you're right about that. And I think when we look at the number of sales by price since March, 70% in Manhattan are below $2 million. So there is something about, you know, getting the unit mix right and getting the sizes right within the various unit types. And Adam mentioned 15 Park Row, and I think that's a good example where they had some 1-bedroom, 1.5 bathrooms. Their 2 bedrooms, their 3 bedrooms are not oversized. So your purchase price is more cost effective than what you're finding on 57th Street. And as a result, they're getting more, you know, more demand, more sales there.
Yeah, and we're seeing the same thing. I think it really is a function of, you know, price point, efficiency of units that's driving a lot of the sales right now. And I think that is a lot more prevalent in the boroughs, just given the type of product that was being built and has been built. And I think there's Mark, to your point, a lot of all the projects that we're talking about now were conceived in 2015, 2016, so 4 or 5 years ago. And if we remember, that was at a time when the 421A program, the tax abatement program, had expired. So building a rental building in New York City was really not feasible at that time. So anyone who was interested in development of residential product had to build a condo, had to plan for a condo. So you had this 2-year window where there was more condo being planned than probably would have otherwise if the 421 tax abatement program was in place. And that's probably more prevalent, that consequence is probably more prevalent in the boroughs. I mean, there was a glut of high-end inventory in Manhattan pre-COVID. So I don't think that really drove that so much. That was really, to Mark's point, I think just there was a perceived demand for super luxury apartments. But I think in the boroughs, there's a lot more condo product being delivered right now than there would have been otherwise if 421A had existed.
So I mean, also, I would imagine that the price, you know, the price of land also has been a huge factor in what's been developed over the, you know, during this past cycle. The land pricing in Manhattan for condominium product probably, approached $1,000 a foot. And, then on average, I would say it was more in the, $600 a square foot range in the last several years. And, you had no, the only thing you could build was condos. I mean, to build a rental, Jamie would be able to answer this better, and Dovi, but I would imagine you have to be somewhere in the, $250, $300 square foot range, and to build a rental and underwrite $90 to $100 square foot rents.
Yeah.
And not to put a finer point on it, how do we then get to whatever this next phase is, right? So you're dealing with a bunch of overpriced pieces of land that are finally coming to fruition, that have a choice to either, kick the can down the road now for another 6, 3, 9, 10, whatever months it is in forbearance, continue to carry it, continue to pay insurance, property taxes, whatever you're paying, and then expect to come out the end of it and still to sell off or, devise your liquidation plan in terms of recognizing any kind of capital, right? I just don't see how that becomes more realistic as time, i.e. expenses and costs, continue to go on.
Yeah. I mean, your basis is increasing on a day-to-day basis,
Right.
to your point.
Yeah.
Yeah. I mean, I think, unfortunately, like Marc framed it, there's going to be a lot of haves and have-nots. And I think it's going to require a massive adjustment to capital stacks. And that's going to entail wiping out huge swaths of equity. Again, the rubber has not met that road yet.
Yeah.
So sponsors have been able to hold on, and they would rather have their basis increase than lose their deal. But I think in the near future, you're going to start seeing large adjustments to capital stacks for certain projects.
I mean, this question, I guess, is for Marc from Ackman-Ziff. 2 years ago, the available liquidity for inventory loans was robust, and it was very reasonably priced, from what I understand from our clients. And what does the price of that capital look like right now, if it's even available?
Yeah, I mean, I think it is available, but it's going to be selective. And I think that what you're finding is that a lot of the sources of capital that were providers of financing for construction for these projects are a lot of the same guys that you're going to turn to look for capital for inventory loans. And there are new entrants, and there's funds, and the funds are flush with capital. But, to answer your question, what our experience is that if you want true senior type of bank financing, you're looking at, guys who want to be sub $800 a foot. They want to be $700, $800 a foot, below 50% loan to current value of these units. And that, that money is probably in the 5% range, 4.5% to 5.5%. And if you want to go higher, if you want to get up to more in the $1,100 to $1,200 a foot range, you're looking at more of the debt funds, and they're going to look for rates more in the 7.5% to 8% range, I would say, plus fees. So, the money's out there, but it's going to be selective. It's going to really be focused on what is the inventory that we're financing? Is there adverse selection in the remaining units? Are there a lot of outlier huge penthouses that we're relying on to get repaid, or is there good diversity within that portfolio? So,
have there been any condo inventory loans that have closed, since the summer that you're aware of?
We have not at our firm done a condo inventory loan in New York that I'm trying to think of. I mean, when we closed, knock on wood, 40 plus deals, we're a boutique firm, so we're not a national services firm. We've got, a bunch of people in New York and then a handful of people in other offices. We closed close to $3 billion during COVID. And I don't think that there is one condo inventory deal in there. We're actually in the market with one right now for a bulk purchase, but not in New York.
We recorded 2 condo inventory loans. They were recorded this summer. Oh no, I'm sorry. Pardon me. Sorry, this is the wrong. I was looking at the wrong date.
Rob, and I've heard, and and speaking to our capital partners and our lenders, I've heard that condo inventory loans have really dried up. I think there was a large sort of swath of them being closed in the spring, early summer, and then as summer went through, I think lenders started getting a lot more shy regarding inventory loans. And from what I understand and what I've heard, there's very few that are occurring right now. I think people are waiting to see where it lands.
Right. So that would be sort of like the rubber, where the rubber meets the road, right? You know, if you can't get a condo inventory loan, or it's priced at L plus 10 or whatever it is, and you start to look at that interest carry over time, you know, you're going to throw good money at bad, you know, and that's, I think, is sort of, you know, where some of these situations are headed. Not all. I don't think, you know, I think we have lots of projects that we're representing throughout our portfolio that are still performing well and that we're all confident in, but there are definitely some that will eventually have to go down that path.
Yep.
Well, I want to turn to Brooklyn and so get an idea of is any of this conversation different in Brooklyn, or more or less, like in terms of
I'm happy to give the quick Brooklyn stats if you want them.
just well, like super quick, not
all right. March 13th to June 22nd, 186 new development condo units were signed, at averaging 13 per week. June 22nd to now, 352 units at 16.8 per week, and that's a 39% drop in sales volume year over year. But interestingly enough, the average price reduction in Brooklyn was only 5%. So the strength in the Brooklyn condo market is, in my opinion, actually more stable than some of the Manhattan stuff. And we're continuing to see reasonable absorption in Brooklyn. And I think that the majority of the price points that are selling are this sub $3 million market. For example, Jamie, you know, has got a great project in Brooklyn Heights that I'm sure he's happy to talk about, but they've, you know, sold, I believe, somewhere between 20 and 25 units since they started sales.
Yep. I'm actually in the sales center right now.
Patrick, are you?
Where's your kitchen?
Yeah. I think the story for core Brooklyn and Long Island City is very similar right now. They're both benefiting from buyers who are now comfortable leaving Manhattan, and they're looking for more space for, you know, just a better bang for their buck. So Brooklyn is delivering that right now. Long Island City is delivering that right now to some extent. And the price points, you know, below $1 million, I think are selling surprisingly well. In October, there were more signed contracts in Long Island City than there were in October of 2019. So we have seen good strength, and I think one of the elements that Brooklyn and LIC benefits from is the captive audiences of renters. When you had the rezonings 15 or 20 years ago, it brought all of these rental units. So you have a group of people who are coming from Manhattan, but then you have an existing group of people who already live in Brooklyn, who already live in Park Slope or whatever neighborhood it is. They know and love the area. They've been renting there, and now they look at this as an opportunity to buy. So I think that's a very good strength for Brooklyn and Long Island City. You have people who are already living there who want to become homeowners there.
But if a project is not selling well, is it typically because of like a location, or like the ones that are relatively
it's a very good question. So someone mentioned, you know, avoid broad brushing the market, and that's something that's unfortunately done too much. But even in Brooklyn or Long Island City, there are projects that might be in the right neighborhood, but they don't have the right unit mix. They either don't have the right distribution of units, or their units are oversized, and maybe the construction quality is not, you know, there wasn't an emphasis on construction quality. So you can have issues even within a market, even within a submarket that's doing well. You can have buildings that are underperforming because of unit mix problems and product problems, and of course, pricing is very important as well. But we do see buildings that have the wrong product.
What I was looking at the lawsuits, and there was a 25 Park Row, which is a building that's doing well in this context, but somebody had sued for rescission because they said it wasn't, it was their personal time that they had filed, and it was supposed to be, you know, whatever, that's sort of the lawsuit. I'm not interested in that, but just the concept of a rescission. Are people doing that because they just want to maybe buy again at a lower price, or is it?
Yeah,
like the psychology of a rescission these days?
Yeah. That's it. I mean, I think, you know, at our project at the Snyderman, which I'm in the sales center in, but we have been selling quite well. Once we were able to reopen sales, Robin said there was a period of time where the sales process just completely shut down. We were effectively able to reopen with like confidence and effectiveness at the beginning of August. We sold 6 units, and I think generally speaking, market wide, that's very good. And I think it's completely derivative of the fact that in comparison to a lot of other markets, our price points are quite low, and the boroughs are delivering units and selling condos at, quite frankly, a fraction, 30% sometimes of Manhattan. So it's we joke that you have a 1-bedroom apartment that's $900,000, and that's considered workforce condominium housing in New York City. It's absurd, but it's true. And there's a lot more activity in that sub $2 million space. And the majority of apartments, condos, homes in Brooklyn are sub $2 million. So you are seeing just a disproportionate amount of activity as a function of that.
But the ones that are not selling, I'm sort of interested in the ones that are not. What is it typically? I mean, this is just sort of in your mind when you think about them. Is it, I don't know, Dovi, if you're looking at some in Brooklyn, like, is it because they put it in the wrong place, or they just did a kind of a sloppy job, or?
I mean, that's a lesson, right? But I think what we did find, which was interesting, and Jamie, I'm curious to know your opinion. The developers that have from Manhattan and now moved on to a Harlem, a Brooklyn project, the amenity package that they're delivering is in some cases the most bizarre, right? And you would think that they would get to understand the local Brooklyn, Harlem sort of marketplace and implement a amenity package that fits that neighborhood and community. And we often find that it's either too large, expansive, one that is just extremely costly, and the carry is ridiculous. So I'm curious from your perspective, how do you guys approach it, Jamie?
So, I mean, it's very nuanced. It's, in particular, you can look at downtown Brooklyn. It acts as sort of a hub to a lot of the historic neighborhoods that are the most desirable in New York City. And you're right, there's a lot of more national builders that came in, a lot more, call it, I guess you call it national builders. A lot of large development companies came into the Brooklyn market over the past 10 years, and they tried to take their Manhattan formula and drop it into Brooklyn or different areas in Brooklyn. And the fact is that, over the past 10 years, Brooklyn has become a bit of a cultural, icon, right? People move here because they like the cultural amenities, they like the streetscape, they like being outside. So unlike downtown Manhattan, where that street level life doesn't exist, so you need hugely robust amenities to drive demand and to accentuate demand, you are thinking about it incorrectly if you think that's going to have the same effect in Brooklyn. Because people are moving into Brooklyn because they want the sort of the culture of the life, the street level life, and you don't need the amenity packages that you have in Manhattan here. You just don't. But I think there's programmatic inertia when you have a 400 or 500 unit building that you need to have X, Y, Z amenities. It's just sort of like checking boxes at a certain point, but it truly doesn't help demand at all.
Yeah, and Adam, to answer your question, that's what we're finding is we recently dealt with a developer up in Harlem who was accustomed to building in primarily downtown, and he got way in over his head on the amenity package, just couldn't get ahead of it. Still, oddly enough, he held on. His lender gave him yet another forbearance, and from what I hear right now, it's going to be leased out entirely to the city for a homeless shelter. So I'm happy for the homeless program. I don't get the math and how you arrive at that, where there's Venetian plaster in a swimming pool, and you arrive to that program and how that sort of survives, whatever the carry costs are. But it's truly, it's phenomenal to see happening and unfold on a day-to-day basis.
Yeah. I'd like to turn to Queens and look at some of these projects. There's a very interesting case there. the one that we selected as a good selling project is actually out in Flushing, where they've just been. I just see it. I'm looking at these transfers every day, and I just kept seeing more and more from this 132-35 Infinity 8. But the one that I wanted to ask about is where there's one unit sold, the Skyline Tower, and it doesn't have a TCO yet. It just seems like an interesting case. Patrick, I don't know if you want to specifics or just the concept of getting selling a unit without a TCO.
I'd really defer to the developers on the panel, or maybe Robin. I mean, you could, if you were, why would someone buy before the TCO was issued? You know, perhaps it was, I'm not, you know, does Robin want to, or one of the developers want to take a shot at this one?
Hypothetically, not trying to.
I don't know. I guess we'd have to understand the details of the unit, but I mean, it's possible that was a commercial unit within the building, but I'm speculating.
Mm-hmm.
Yeah, and sometimes those are transactions, if it actually closes, or friendly transactions. So it's either an associate of the developer or whatever, and oftentimes, you know, those sort of transactions occur when there's a lender requirement to have a closing by a certain date. So they rush a closing in order to meet that covenant. But I don't know the particulars of that.
And then just generally in Queens, just or in the LIC market, Patrick, just are you seeing a differential between buildings that have certain types of units and that some are too big or some are too small? That's sales?
Yeah. So we see a big drop off in demand in LIC above 1.5 million. So, you know, below $1 million is still very strong, but there is negotiation happening even below $1 million. So the buyers who are in the market, there are lots of buyers. The market is very active, but they're encountering sellers who are more reasonable. So you have sellers who aren't, you know, they don't have aspirational pricing, and you might be able to go into a new development today and get a nice incentive package. So you do have stronger demand right now in LIC than many parts of Manhattan, but you're not having price increases in LIC. You are encountering, you know, sellers who are ready to make deals.
And in terms of not just the price point, but the actual unit mix size, is that also impacting?
Yeah, it is. We're seeing a lot of demand below $1 million. So I would say it's heavily concentrated there, probably, you know, 60 to 70%. And then 1 million to maybe, you know, 1.5 million is your next sweet spot. And then when you get above 1.5 million and certainly above 2 million, your demand really, you know, goes down considerably. So you have buildings today where you might have two condos on on the same block. One has efficient studios and 1 bedrooms and maybe one line of 2 bedrooms. So maybe 75% of your mix are smaller unit types, and they're efficiently designed, beautiful units, not extensive amenities. So you have low carrying charges, and you might have a building on the same block, same location, that has better views, that's taller, but their average unit sizes are just so big that the purchase price becomes cost prohibitive for the typical buyer in Queens.
And I would like to, well, actually, anyone else looking in Queens? Dovi, have you been looking around there, or have you?
One rental, no.
All right.
I think
it's just
Our company is representing a project called Gallery, which is 184 condos in Long Island City, and it's you know, we have people moving in every day. The building's, you know, above 75% sold at this point, and pricing has remained relatively stable. There's certainly a little bit of negotiating going on, but it's been a successful project, and we did get the Amazon gift for about 3 months, but that went away. So that helped our absorption a few months. But I agree with Patrick. There's a lot of demand in LIC, from, you know, sub $1 million to $1.5 million. It does start to to wane once you get above $2 million. But I do think that that market is continuing to mature. There's a ton of people living in the neighborhood with all the rental towers that have been developed over the last decade. And I think also as Hudson Yards, starts to open and, people start occupying office buildings, it's going to be one of the most direct train lines, Long Island City straight to Hudson Yards.
I've got a question from someone from the audience who says, if Brooklyn is doing so well, what's wrong with the Extell condo tower? I don't know. That's not part of our mix right now. I don't know if they've started closings yet, but is that 138 Willoughby? Is that?
So that's Brooklyn Point. It's a condo. They've, I believe they've sold 44 units to date. They do have a 25-year tax abatement. They certainly have more units in contract, but they've commenced closing. So we don't know exactly how many are in contract at this point. And interestingly enough, it's going to be a difficult one to track because it is a condo. So you don't have to, you can't go into Acris and see all of the, the contract sign dates.
Right.
So it'll be a challenge to sort of really get a firm understanding of how much inventory is selling on a monthly basis.
But compared
they
to
have started their sales process, their closing process.
Looking at other product in that area, are they all kind of the same, doing okay, or should it be going a little
Jamie?
I think it's pick and choose. I think some of the larger buildings are faring a little worse than some of the more boutique size projects.
Mm-hmm. For what reason? Like what? Just not to pick, but I mean, why would that matter?
I think it's the mentality of a Brooklyn purchaser. So in downtown Brooklyn, it acts as sort of the dense hub for a lot of low dense neighborhoods that are the most attractive in New York City. So there's a huge amount of demand for people who want to live in Brooklyn Heights. There are very few people that can buy in Brooklyn Heights, and it out of just being priced out, and then also just there's not available product because it's a landmark district. So they end up moving or buying or renting in downtown Brooklyn. So but it's not. It's a little bit disjointed from what people are looking to buy for. They want to buy something. They want to buy a townhouse. They don't want to buy a 50-story tower in downtown Brooklyn. Again, I think part of that has to do maybe with a little bit of a mentality of picking up more of a Manhattan product, approach and trying to drop it into downtown Brooklyn when there's a lot more nuance here. But I mean, 11 Hoyt is another project it's a beautiful building. It's 400 and some odd units. I think that they're selling relatively well. I think they're probably selling a little bit better than Brooklyn Point. Robin, is there?
Yeah, I mean they're priced a little bit less expensive, but
right.
Yes, they are. I believe have more units in contract. I believe they just also
started closing.
Got their first TCO. I believe. I don't think they've started closings, or maybe they have. But those two projects, when you compare them to the greater downtown Brooklyn market, they could be 20% more expensive than others. For example, we have a project called Brooklyn Grove at 10 Evans Street, and we've sold more than 100 condos there. Probably averaging around $1,300 per square foot. Brooklyn Point and 11 Hoyt could be as high as $1,800 per square foot. So it's just a different product type. Ours is a 24-story building. It's got a nice amenity selection. We have also noticed for that building that the most demand has been in the studio 1 and 2 bedroom class. It's been challenging to move 3-bedroom product in that particular location in that particular building.
Yeah.
And looking down the line, then we're going to do a panel on foreclosures and bankruptcies. There's hardly any bankruptcies being filed right now, but there's actually a ton of single-family foreclosures and tax foreclosures happening. Is that starting to happen to any of these developers? Do you think anyone's getting closer to foreclosures now? Dovi?
No.
You're thinking of that.
No. I think this becomes a reality probably at the end of, I doubt in Q1, possibly mid to the end of Q2 of 2021.
Just
I don't-
forbearance, what you were talking about before.
Yeah,
is keep-
it's kick the can, and figure it out eventually.
I think also when you look at these projects, because they're not income producing, that, you know, for a lender to take on to their balance sheet the obligation of the taxes and the common area charges for unsold condo units is not, it's not an appealing, you know, outcome. So they will put as much pressure, I think, when it gets to the point where they really need to get repaid. If you have a developer who's really back against the wall, can't find the capital to put up reserves, et cetera, then they would look for some other exit, you know, probably a sale of the note to a third party who would then maybe look to foreclose or work a different deal with the developer. It's just that for regulated institutions right now, the last thing they want to do is take a swath of unsold condos onto their books.
Yep.
And are the new condos that are coming on the market right now, like we've just been tracking a couple of new condo decks. There's been sort of a lull for like a month and a half, barely anything, but now there's been a couple coming on. Where do they position themselves? Like Patrick, are you guys looking at new stuff coming on the market in LIC right now?
We're working on a couple of buildings in the pipeline right now, and we were able to go in there and change some of the layouts to kind of reflect the new environment where someone might want a home office area, and other changes. So we're kind of recommending more efficient units and getting away from the larger unit types, which seem to have less demand. So it's that same theory of really building to the market that exists, not to a market that we hope will be here.
Mm-hmm. Right.
It's also worth noting that I think, a lot of people are talking about any changes in development from coming out of COVID. And I don't see how, besides, showing a desk in a living room and showing that you can work from home comfortably in a unit, I don't think there's a lot of sort of structural changes that can occur in development. I do think, and I think Patrick could probably support this, there's a lot more activity across the city for apartments that have outdoor space. Because I think people are valuing outdoor space a lot more today than they were prior, and I think that's just a direct result of
I would agree.
We had an interesting statistic on the Upper West Side and Morningside Heights. Since COVID, over 50% of all contracts that were signed have some form of outdoor space on the Upper West Side and Morningside Heights, and which was really a mind-boggling statistic. So yes, I agree with the outdoor space comment.
You have the context for what the total is that out of only 10% of units have outdoor space?
I don't know the exact number on.
Okay.
On that. Also, to what Patrick said, we have a new project that we're going to launch sales in the beginning of next year. It's called VU at 3rd Avenue between 26th and 27th Street. It's a 30-story condominium tower, and the unit mix design there was very efficient. It's got studios, 1 bedrooms and 2 bedrooms, but smaller units, meaning 650 square foot 1 bedrooms, sub 1,000 square foot 2 bedrooms, and then 1,700 square foot or less 3 bedrooms, which is going to be a unique product type for that sub market in the sort of Gramercy, Kips Bay, Nomad area, with real views. So it'll be interesting to see how it performs compared to some of these other buildings that have more, I'll call it gracious, size units, because the absolute dollars will be certainly less and the price per square foot will be similar.
Well, thanks. And I wanted to conclude with that. I want to thank all the panelists, Marc Sznajderman, Robin Snyderman, Patrick Smith, Dovi Lesches, and Jamie Anthony. And please join us next time. We'll be discussing foreclosures. And thank you and have a good afternoon.
Thank you.
Thanks, Adam.
Thank you.
Thanks for having us.